Now we're back on a business alert. The market's been flashing some signs of a possible recession coming out of the bond market, at least. Former Fed Chair Janet Yellen, meantime, saying that the bond market indicator could mean a rate cut, not a downturn. Chicago Federal Reserve Bank President Charles Evans says he's still confident about the U.S. economy. So everybody has an opinion on that. We're hoping our next two guests do as well. Market watcher Lindsey joins us, and from Raymond James Chief Economist Scott Brown. Scott, you first on basically the essential debate that's developed over the last few days. You get an inverted yield curve, and it means recession. Does it?
I think the yield curve has been probably the single best indicator of recession that we've had over the years. But bear in mind, it typically may take a year or more before between when the curve inverts and when you actually fall into a recession. Right now, the curve is mostly flat.
Yep.
You know, if you look from the 10-year to the federal funds rate, and that's consistent. If you look at just a simple model of recessions, probably about a 30% chance of a recession within the next 12 months. So, you know, the odds don't favor a recession here, but the odds certainly have increased, and it's certainly something to watch going forward, I think.
Yep. The idea, Lindsey, when these longer-term rates fall below the short-term rates for an extended period of time, I guess those odds that Scott was talking about would probably go up. But what's your read on what we're actually seeing right now?
Yeah, what you actually see after the yield curve inverts, first of all, let's see if it stays in negative territory for more than one day. But what you usually see is you'll end up seeing the S&P 500 peak about 18 months after that. So this is actually a signal to buy in the equity markets right now. So we think that that is one thing that investors should take into consideration. It doesn't necessarily mean you need to jump out of the market right here, right now. But I think that we are signaling a slowdown. Last week, investors, both in the bond and equity market, really had a bad week after they heard the Fed talk down their earnings, or excuse me, their GDP growth expectations. And then you had the PMIs from Europe come in much weaker than expected. So that led the 10-year to drop precipitously, and that is what's causing the yield curve to invert.
I want to go back to Scott in a moment on those questions about overseas growth. But, Lindsey, let me stay with you on the stock market just for a second, because you bring up an interesting point, and that is just because we see a sign that the economy is slowing down sometime into the future, doesn't necessarily mean that stocks will sell off. In fact, to your point, it may mean the opposite will take place. Why is that the case?
Well,
yeah,
very
I
often
think
when the yield curve does...
Sorry, Scott, I just wanted to get Lindsey's take on that real quick, and then I'm going to come back to you. I'm sorry if I wasn't clear. Lindsey, go ahead.
All right.
Yeah, no, because the reason that happens is because the banks, when the short end of the curve is yielding more than the long end of the curve, the short end is where they borrow from. So they're paying more to borrow money that they're going to lend out at a lesser rate. So because of that, banks stop loaning. But that takes time to work through the system. So it doesn't happen overnight. And that's why it takes a long time for an inverted yield curve to really result in a recession.
Okay, fair enough. So, Scott, why don't you pick up on that in terms of the timing and how these things usually play out, and if there's anything different, given what we're seeing maybe in Europe or other parts of the world, is anything different about this particular time?
Well, I've been through a number of these, and I have to say that every time the yield curve inverts, people come up with reasons why this time is different. And in this case, you are seeing weaker global growth, which is putting downward pressure on long-term interest rates outside of the U.S. The German 10-year is now below zero again. And that does put a lot of downward pressure on U.S. bond yields. So some of that inversion is because of that. But when you typically talk about an inverted yield curve, you're talking about expectations that short-term interest rates are going to decline.
Right.
And if you look at the federal funds futures, you look at the 2-year Treasury, you know, that expectation is built in there. So why would the Fed be cutting rates? Because the economy is going to weaken. And then you run into this issue of, well, could that become a self-fulfilling prophecy? Certainly, if consumers retrench, they stop buying big-ticket items, that could weaken consumer spending growth. But business fixed investment is one where they could curtail expansion plans and reduce hiring.
Interesting. And, Lindsey, your take on that in terms of how it plays out over the next, year to maybe 18 months?
Well, what I would say is that while everyone last week was very worried about this global growth slowdown concern, and that's what you're seeing in the markets, what we're starting to see in the economic data, though, is a slight turnaround. Granted, it's still very early stages, but if you look at some of the latest economic data, one of the greatest data points was housing starts last week, but the index of leading economic indicators, you've got retail sales, consumer sentiment, and consumer confidence all moving higher from their January lows. Granted, still very, not at the highs that we most recently saw, but we're starting to move higher. And as we move away from the shutdown and throughout this year, and the financial conditions in the market are loose, the Fed is standing pat on interest rate hikes from there. There is a potential for the market to start to pick up, the economy to start to pick up as we get further down the road. All
right, Hillary, we're going to Hillary next. Lindsey, thank you. And Scott, thank you to you as well.